Okay, let's unpack this. Here's a number that really sticks with you. After more than 150 years since the end of slavery, Black Americans collectively own only about 1% of the wealth in the United States.
1%? Wow.
Think about that. It's a figure that has barely crept up from the 0.5% they held as newly freed people. And this isn't just some abstract social issue. Our sources make it powerfully clear that this gap is deeply fundamentally rooted in the very structure and history of America's financial system.
Right. It connects back to what Martin Luther King Jr. said, doesn't it? About America giving Black people a bad check.
Exactly. A check which has come back marked insufficient funds. That quote really hits home when you look at these numbers.
And that phrase captures the essence of it. It points not just to individual lack, but to a systemic inability or perhaps, an unwillingness to provide the resources and access needed for equitable wealth creation across generations.
Exactly. So in this deep dive, we're tackling a stack of documents that lay bare this intertwined history of race, wealth, and banking in the U.S. Our mission is to understand how the architecture of the American financial system, specific government policies, and, frankly, explicit racial exclusion work together to forge this persistent wealth gap.
And what that history means for the economic reality of individuals and communities today, right?
Precisely. We'll journey from the immediate aftermath of emancipation and the bitter taste of broken promises.
Yeah.
Look at the attempts within the Black community to build their own financial foundations. Examine how government policies actively built segregated financial markets.
Which is a huge piece.
Huge. Then explore the vacuum left by mainstream banking and how high-cost lenders moved in. And finally, see what the sources tell us about the enduring challenges of accessing fair credit and building wealth in the present day.
It's a complex story, spanning centuries, but absolutely vital for grasping why the economic landscape looks the way it does right now.
So let's start at the very beginning, right after emancipation.
Right. The starting line for Black Americans was essentially zero wealth. This isn't just historical context, it's the foundational reality.
Zero.
Under slavery, people were not only denied ownership, they were property. They were assets used as collateral for loans. The sources mentioned they were sometimes literally depicted on currency notes.
Wow, being used as collateral. The sources really hammer home that people were the capital.
They were.
And wasn't there talk of land, the famous 40 acres?
Yes. The promise of land was there, this idea of a path to agricultural independence, but it was quickly withdrawn, rolled back.
So instead of land...
Instead, the focus tragically shifted from land ownership to simply encouraging thrift and savings.
Which brings us to the story of the Freedmen's Savings Bank. This is such a critical early example and, frankly, a painful one to read about.
It really is. Created right after the war, the bank was presented to freed slaves as a secure place for their hard-earned money. And the sources highlight how deliberately it was made to look government-backed.
How so?
Images of Lincoln, Grant, General Howard on the passbooks, flags draped over the buildings. It was an explicit effort to build trust with a population that had every reason to distrust institutions.
Okay, so build trust, encourage saving. And initially, it was intended to be simple, right? Just a savings bank, a safe place.
That was the initial intent, yes. A magnificently constructed, highly regarded, and heavily advertised piggy bank, as one source describes it. Pure thrift.
But that's not how it played out.
No. This is where it goes terribly wrong.
Yeah.
It quickly morphed into something else entirely, a highly leveraged investment bank. Insiders, like Henry Cook, began speculating wildly with depositors' money.
With the Freedmen's Savings.
Yes, in risky ventures, like railroad finance, completely without the depositors' knowledge or consent.
So the money people are painstakingly saving was essentially being gambled away. The sources call this counterfeit capitalism.
Precisely. It was a total perversion of true capital accumulation. And you had well-meaning officials focused on the moral virtue of thrift, like John Alvord, giving earnest advice about saving.
While the bank was doing this behind the scenes.
Exactly. While the institution itself was engaged in these incredibly dangerous practices.
The failure of that bank, the impact must have been absolutely crushing.
Catastrophic. Financially, obviously, it wiped out the savings of thousands of freed people. But just as important, maybe more so in the long run, it inflicted deep psychological damage.
Distrust.
A profound and understandable distrust in the formal banking system that would echo for generations. It was a foundational betrayal.
Okay, so that's the starting point. Starting with nothing, seeing initial attempts at building wealth through savings just destroyed.
Yeah.
How did the broader mainstream banking system interact with Black communities during this period?
Well, this is where we see a really stark difference in how the system served different groups. The sources point out that major banks, like the Bank of Italy, which later became Bank of America, specifically catered to and helped white immigrant groups. They provided access to credit, helped them buy homes, start businesses, integrate economically. They actively facilitated their wealth accumulation.
But that same mechanism, that same help, wasn't extended to Black Americans.
No. By and large, access was denied. And as Reconstruction was rolled back, legal barriers started reinforcing this exclusion.
How so? What kind of barriers?
Key Supreme Court decisions, think slaughterhouse cases, Cruikshank, Plessy v. Ferguson, severely weakened the federal protection of Black citizens' rights.
Right.
This effectively allowed states to establish and enforce segregation. The courts, in effect, prioritized property rights and the ability of states to control economic and social life over protecting Black people from violence and economic exclusion.
Prioritizing property rights over fundamental civil rights and safety, that sets a grim stage.
It really does. By 1900, one source puts it starkly, saying something like, "The slave law of the South may have been dead, but it ruled us from its grave."
Wow.
The legal and social structure just ensured continued economic subjugation.
Given that deliberate exclusion from mainstream finance, it makes complete sense that Black communities would feel the urgent need to build their own financial institutions.
Absolutely. The rise of Black banks wasn't some abstract economic theory. It was a direct response to being shut out. They were born out of pure necessity.
And the sources mentioned there were other types of alternative financial institutions developing around this time for working people in general, not just Black Americans.
Yes, that's helpful context. It wasn't happening in a vacuum. There was a broader landscape of alternative models for working and lower-income people.
Like what?
Savings banks in the 1800s, often nonprofit, focused purely on thrift for the poor. And building loans, the B&Ls, they were crucial. People pooled their small savings to finance home buying for members.
Sort of like early credit unions for housing.
Kind of, yeah. They were seen as a perfectly democratic, a people's banking system. And then you had Morris banks, early 1900s, pioneering small, short-term loans for salaried workers, a market mainstream banks totally ignored.
Okay.
Arthur Morris even coined the phrase democratization of credit in this context.
So the idea of alternatives wasn't unique, but the Black bank movement had its own specific set of hurdles because of segregation.
Exactly. And within the Black community, there were different philosophies about the best path forward. Booker T. Washington, for instance, famously championed Black business and banking.
His Atlanta Compromise approach.
Right. He argued it was a means to gain respect and acceptance through building industry, thrift, intelligence, and property. He really pushed for creating a Black financial infrastructure within that segregated system.
But the sources point out that not everyone agreed with that strategy.
No, definitely not. Thinkers like W.E.B. Du Bois pursued different strategies, focusing more on political rights and integration. And economists like Abram Harris were particularly critical.
Harris, what was his argument?
In his work, The Negro as Capitalist, Harris argued that Black banks operating within a fundamentally discriminatory and segregated economy faced inherent disadvantages that made them structurally weak. He saw them almost as a kind of economic trap.
A trap.
Yeah.
How? What were those fundamental disadvantages?
Oh, there were so many layers. Just getting charters to operate was often difficult because of opposition from established white banks.
Really? They'd actively block them?
The sources suggest that happened, yes, like an example in Harlem. Plus, they lacked established connections with the broader white banking system, which made simple things like getting liquidity or selling off loans much harder.
Okay.
And crucially, their customer base serving a low-wealth clientele meant deposits were smaller, more volatile. This naturally led to higher operating costs and lower profit margins. As the sources put it very bluntly, banking the poor is not highly profitable.
That makes intuitive sense. More work, smaller transactions, less return on average.
Right. And to offset the higher perceived risk of serving a lower income base, regulators often required them to hold higher reserves and capital ratios compared to mainstream banks.
So more restrictions?
More restrictions, less flexibility. And here's a key economic insight the sources highlight. Black banks struggled to effectively utilize what's called the money multiplier.
Okay, let's pause on that for a second. For listeners who might not be familiar, what exactly is the money multiplier? Can you break that down?
Sure. It's a fundamental concept in banking. In simple terms, it's how banks actually create new money and fuel economic activity. When you deposit, say, $100, the bank only has to keep a small fraction, maybe $10 in reserve.
Okay.
It can then lend out the remaining $90. That $90 gets deposited by whoever borrowed it into another bank, and that bank keeps a fraction and lends out the rest. So your initial $100 deposit gets multiplied into a much larger amount of money circulating through loans in the economy.
Got it. It expands the money supply through lending. So why couldn't black banks do that effectively?
Because their core inputs were different. Their deposits were, relatively speaking, costly to acquire lots of small amounts, frequent transactions. And the loans they could make were largely confined to a segregated economy that offered fewer opportunities for profitable, large-scale lending compared to the mainstream economy white banks operated in.
So they couldn't generate the same volume or scale of loans.
Exactly. They just couldn't participate in that broader money creation process as effectively.
And the sources make this really striking, almost paradoxical argument that despite being created to keep the black dollar circulating within the community, black banks sometimes ended up being a mechanism for black money to flow out of the community and into the white banking system. How does that work? That seems counterintuitive.
It is ironic, isn't it? But think about it. By taking deposits, that money entered the formal banking system. Even if lodged in a black bank, that bank was still operating on the periphery of the larger financial system, which was dominated by white institutions. While they facilitated some local loans, which was vital, the net effect, because of reserve requirements and correspondent banking relationships, was that capital could ultimately flow towards the center of the system, the mainstream financial architecture from which black communities were largely excluded from the core wealth-generating activities.
Wow. So a necessary institution, but caught in a structural bind. Were there any instances where black businesses and banks did manage to thrive despite these incredible odds?
Yes, absolutely. Durham, North Carolina, is often held up as a prominent example, sometimes called the Black Wall Street.
Right.
One reason cited for their relative success, according to the sources, was that they were able to cultivate and serve white clientele to some extent.
So they weren't solely reliant on the segregated economy.
Exactly. That allowed them to participate in a larger, potentially more profitable market, moving beyond some of the limitations imposed by strict segregation.
Right.
But, and this is crucial, the sources grimly note that the Tulsa race riot, the destruction of Greenwood,
Another Black Wall Street.
yes, was explicitly linked to white resentment precisely because of black economic success in that community.
That just underscores the immense difficulty even achieving success could invite violent backlash. It's sobering.
Deeply sobering.
All right, let's move forward significantly in time. How did major government policies, particularly during the pivotal New Deal era, continue to shape and, it sounds like, deepen this segregated financial landscape?
The New Deal is absolutely critical. It's a turning point where government policy actively, you could say deliberately, exacerbated inequality, even while creating essential programs.
How did it do both?
Well, while it created important social welfare programs and modernized the credit system, it did so in a deeply discriminatory way. Foundational programs related to regulating hours, supporting unions, setting minimum wages, even Social Security.
Things we think of as universal safety nets.
Right. But they explicitly excluded job categories where black workers were heavily concentrated, particularly farm workers and domestic laborers.
Why? Why exclude them?
This was a direct result of concessions made to powerful Southern legislators who insisted on maintaining the existing racial hierarchy and cheap labor supply. It was baked into the legislation.
So programs meant to build a safety net and economic security deliberately left out a huge segment of the black population from the very start.
Correct. And this gets even more intense, even more central to the wealth gap when we look at housing and credit policy introduced during the New Deal.
Okay, housing. That's key for wealth building.
Absolutely central. And this is where government action was arguably most impactful in creating and cementing segregation. New Deal agencies like the Homeowners Loan Corporation, the HOLC, the Federal Housing Administration, FHA, Fannie Mae, the FDIC, these created the modern standardized mortgage credit system we largely still have today.
And they didn't just reflect existing segregation. The sources say they built it into the system.
Precisely. It wasn't passive. They channeled low-cost, government-backed mortgage credit overwhelmingly to white Americans. This fueled the explosion of suburban homeownership in the mid-20th century.
Which was the engine of middle-class wealth creation.
Arguably the single biggest engine of middle-class wealth creation in U.S. history.
Yeah.
And at the exact same time, these same agencies explicitly trapped black families in urban centers through policies like redlining.
Redlining is a term many people have heard, but the sources provide shocking detail on how intentional and codified it was.
They really do. The HOLC created these infamous maps assigning risk grades to neighborhoods. Areas inhabited by black people, or even areas just threatened by what they called a changing racial composition, were marked in red,
Mean.
meaning they were deemed too risky for lending. No government-backed loans, and the FHA's own 1939 underwriting manual explicitly prohibited insuring mortgages in neighborhoods where racial composition was changing.
They put it in writing, prohibited it.
In the manual, this wasn't subtle. It was government policy mandating racial segregation and officially declaring non-white residents a fundamental threat to property values.
So the government was literally saying, if black people move in, property values are threatened and we will not back loans there. This actively created the conditions for concentrated poverty in black neighborhoods while subsidizing wealth building for whites in the suburbs. It's staggering.
It is staggering. It effectively engineered the white middle class and solidified the black ghetto as a permanent feature of the American urban landscape. And this discrimination wasn't just about neighborhoods. It extended even to those trying to operate within the system.
Like black realtors or bankers?
Yes, the sources mentioned black realtors, prospective black bankers, even when they were trying to facilitate FHA guaranteed loans for their community, faced blatant discrimination. They were denied FHA accreditation or access to the capital needed, even for loans the government was supposedly guaranteeing.
Just hurdle after hurdle. Okay, let's fast forward to the civil rights era. Major legal and political victories were won, obviously, but the sources emphasize that legal equality wasn't the same as economic equality.
Absolutely not. Leaders like Martin Luther King Jr. clearly recognized this. They knew that simply removing legal barriers, Jim Crow laws, wasn't sufficient to overcome centuries of deliberate economic deprivation. Freedom was not enough, he stated powerfully. He called for a Bill of Rights for the disadvantaged, something like the GI Bill, which itself had disproportionately benefited white veterans after World War II. He understood that historical injustice required specific, targeted remedies.
And the sources also connect the urban unrest, the riots of the 1960s, in part to these underlying economic grievances, don't they?
Yes, they frame the riots not just as social upheaval, but also as, in part, protests against the systemic economic exploitation occurring within segregated black communities. Exploitation often carried out by external, white-owned businesses and financial institutions operating in those neighborhoods. The sources even note the phenomenon of so-called soul brother businesses sometimes being spared during riots, suggesting a targeting of perceived exploiters.
And this period also saw the controversial Moynihan Report enter the national conversation about race and poverty.
Right. Daniel Patrick Moynihan's report. It did acknowledge the history of racism, which was important, but it controversially pivoted to focusing on perceived cultural deficits within the black community. His infamous phrase, tangle of pathology, related to family structure as a primary cause of ongoing problems.
So it shifted the focus.
Critics argued, and the sources here echo this, that it shifted the focus away from the deep structural systemic economic issues, the very things we've been discussing, like banking access and housing discrimination, and towards blaming internal community factors.
Were there any policy ideas floating around back then aimed specifically at the economic disparity, at fixing the financial exclusion? The sources mentioned encouraging credit unions.
Yes, there were definitely discussions and proposals. Senator Troxmeyer, for example, pushed hard for expanding credit unions in low-income communities.
Oh.
And there were various community development initiatives.
Trying to address the ghetto money pit, as some described it.
Exactly. Trying to find ways to inject capital and build financial infrastructure. But as the sources correctly point out, many of these models, community development banks, credit unions, had been tried before in different forms, often struggling against the same fundamental economic disadvantages and systemic opposition faced by the earlier black banks. The underlying structural problems remained incredibly difficult to overcome.
Okay, let's move into the later 20th century. The sources discuss the rise of black capitalism rhetoric and, alongside it, the increasing dominance of free market ideology in discussions about black economic issues. This feels like a significant shift in how the problem was framed.
It was a very deliberate shift, and the sources argue it was significantly driven by political strategy.
Yeah.
President Nixon, in particular, skillfully adopted and co-opted the rhetoric of black capitalism or black economic self-determination.
How did that serve him politically? What was the appeal?
Well, it had a dual appeal. On one hand, it resonated with some black leaders and activists who were demanding more power and control within their own communities. The idea of building black-owned businesses sounded like empowerment.
Okay.
But critically, it also appealed strongly to white voters. It offered a seemingly market-based solution supporting black businesses as an alternative to more politically contentious remedies, like large-scale direct government aid, or especially pushing for housing integration.
So it avoided the harder structural changes.
Exactly. The implicit message, as Nixon advisors sometimes put it, was something like, people who own their own homes and businesses don't burn their neighborhoods. It offered a way to talk about addressing urban issues without confronting systemic racism head-on or demanding significant government intervention or redistribution.
So it offered a way to address the symptoms, perhaps, or channel energy without really digging into the historical causes or the ongoing systemic barriers.
That's the argument the sources make. And subsequent administrations, perhaps most notably Reagan's, really perfected this approach. They used free market ideology, tax cuts, and deregulation as the purported solutions to black poverty.
Framing it as creating an opportunity society.
Right, an opportunity society driven by trickle-down economics, all while simultaneously arguing against the types of targeted government aid or affirmative action policies that might directly address the legacies of historical discrimination.
But did these initiatives, things like small business administration set-asides for minority contractors, or later efforts like community development financial institutions, CDFIs, did they manage to overcome those deep-seated challenges faced by black enterprises and financial institutions?
The sources suggest the fundamental challenges largely persisted. Initiatives like the SBA contract set-asides were often controversial, faced charges of inefficiency or not reaching the intended businesses.
And the CDFIs, they were modeled partly on innovative banks like Shore Bank in Chicago, right? Aiming to find hidden profits in underserved markets.
Exactly. That was the idea that skilled market scouts, as they were sometimes called, could identify profitable lending opportunities that mainstream banks were overlooking in low-income communities. But the sources indicate that the fundamental economic reality often reasserted itself. Meaning that the core issue, that banking the poor is not highly profitable within the structure of the existing competitive market, remained a huge obstacle. Finding those hidden profits consistently and at scale proved incredibly difficult for many CDFIs, despite their mission-driven approach.
And this persistent lack of profitability for mainstream banks in these areas leads us to a crucial consequence. When traditional banks decide they can't profitably serve low-income areas, what happens? Where do people go?
They largely pull out. Mainstream banks, especially the large national banks that dominate urban financial markets today, simply don't offer the small-dollar loans or basic affordable credit services that low-income households often need.
They just abandon those markets.
Pretty much. The sources quote banking analysts acknowledging this, saying they can't do it profitably, even where they run by God's angels. It's a structural issue from their perspective.
Even where they run by God's angels. That's a powerful, if cynical, way to put it. So if mainstream regulated banks aren't serving these communities, who steps in to fill that void?
This is where the fringe financial sector absolutely flourishes. Check cashers, payday lenders, auto title loan companies, rent-to-own stores, pawn shops. This whole ecosystem of alternative financial services moves into the vacuum left by traditional banking.
And these services come at an incredibly high cost to the people using them, right?
Exorbitantly high. Predatory, many would argue. Payday loans and check cashing, for example, involve massive fees that trap people in cycles of debt.
Do the sources give any numbers on that?
Yes. Data from the CFPB, that's the Consumer Financial Protection Bureau, cited in the sources, is really eye-opening. They found the average consumer using payday loans had over 10 such transactions a year.
10 times a year.
Yeah, and they racked up an average of $574 in fees alone. Just fees, not including the principal amount they borrowed.
Over $500 in fees annually just to access small amounts of emergency credit? That's a huge drain on already limited resources.
It's an enormous wealth-stripping mechanism. And here's another key point the sources make, contrasting them with how traditional banks should work. These fringe lenders often don't really differentiate borrowers based on risk.
What do you mean?
They tend to charge everyone the same sky-high interest rates and fees, essentially assuming anyone who walks through their door needing their service is automatically high risk. Mainstream banking's traditional value proposition, theoretically, is precisely differentiating borrowers, assessing risk, and offering lower rates to lower-risk individuals. That core function is largely absent in the fringe market.
So everyone gets penalized with the highest rates. And the sources even mention that sometimes services offered through partnerships with traditional banks, like those you might find in big retailers, can end up costing people a fortune too.
Yes, that's a really striking detail. Things like overdraft protection on checking accounts linked to prepaid debit cards. These can function as incredibly high-cost short-term loans.
Overdraft fees as loans.
Exactly. Customers using these services, maybe at places like Walmart, which partnered with banks, often found themselves hit with massive overdraft fees for small negative balances. The sources note customers sometimes chose this because, believe it or not, it felt cheaper than a payday loan.
Wow.
But the implicit annual percentage rate, the APR, on these overdrafts could easily exceed 300% in some cases.
300% APR.
Yeah. These are astronomical rates, far higher than what's typically allowed on formal loans in most states. It's essentially unregulated usury, facilitated sometimes right at the periphery of the mainstream banking system.
So even interacting with the formal system via these kinds of partnerships can lead to incredibly predatory costs. And the fact that government policy essentially allows the outsourcing of basic credit needs for a large part of the population to these often unregulated companies.
Well, as the sources argue, it's effectively an admission. An admission that the government-supported banking sector, the one that benefits from things like FDIC insurance and access to the Federal Reserve's lending facilities, is fundamentally structured to serve only a portion of the population profitably.
And the rest?
The rest are left to the largely unregulated fringe market, to companies whose business model is explicitly designed to make a buck from banking the poor, often at exploitative rates.
Which brings us crashing, inevitably, into the 2008 financial crisis and its devastating and very unequal impact.
Yeah, the 2008 crisis was such a stark illustration of both systemic risk and deep-seated inequality. You had years of financial deregulation leading to reckless behavior and widespread bank failures.
But the banks didn't fail, did they? Not the big ones.
No. Instead of letting market forces impose discipline, which would have meant some very large, powerful banks collapsing, the government stepped in and bailed them out. The sources argue this revealed the immense power of Wall Street ideology and its political influence, interfering with market discipline to protect the most powerful institutions, too big to fail.
And how did the specific legacy of segregation and financial exclusion we've been talking about play into the 2008 crisis for Black communities?
This is where the concept of reverse redlining becomes absolutely central. It's a grim irony.
Reverse redlining.
Yeah. After decades of systematically denying credit and investment in Black neighborhoods through redlining, in the years leading up to the 2008 crisis, subprime lenders began aggressively targeting these very same communities.
Targeting them how?
They flooded these neighborhoods with inferior, high-cost, high-risk, often fraudulent mortgage loans. They pushed these toxic products onto Black homeowners, including many who likely could have qualified for better loans but were steered towards subprime options, and others who had previously been completely shut out of the mortgage market.
So it flipped from decades of no access to suddenly predatory access.
Exactly, from credit deserts to predatory flooding. And when the housing bubble inevitably burst and the subprime market collapsed, the wave of foreclosures that followed was catastrophic. But it disproportionately devastated Black communities.
Wiping out wealth?
Wiping out decades of fragile wealth accumulation, primarily held in home equity. It was a painful, modern echo of that historical pattern the sources keep pointing to. When Wall Street catches a cold, Harlem gets pneumonia.
And Black banks weren't immune either.
No. They also suffered significant losses during this period. For instance, the sources mention losses from foreclosures on loans made to churches, which are often core institutions and major borrowers in their communities. The crisis hit from multiple angles.
It feels like this whole long, difficult history funnels us right back to where we started this conversation, that stark, incredibly persistent racial wealth gap today.
It absolutely does. The sources inevitably bring us back to that current reality. Black Americans holding roughly 1% of the nation's wealth. And they really emphasize why wealth matters beyond just being a number on a spreadsheet.
It's about security.
It's security, absolutely. It's a buffer against life's shocks, a job loss, a medical emergency. It's the ability to invest in education for your kids, or make a down payment on a home, or start a business. It's the foundation that can be passed down to the next generation.
And its absence creates vulnerability.
Exactly. Its absence creates constant vulnerability, leading to those cycles of disadvantage. We see difficulty affording college tuition, increased risk of eviction, the chronic reliance on those high-cost fringe lenders we just discussed just to make ends meet. Lack of wealth is lack of resilience.
Now, there has been a recent push, right? The Black Money Matters movement, encouraging people to move their deposits to Black-owned banks. The sources mention a surge in deposits there.
Yes, that movement definitely gained traction and visibility, leading to a notable increase in deposits at many Black-owned banks. It clearly reflects a powerful desire within the community for self-support, a form of protest against historical exclusion, and a continued hope to build and sustain institutions that are perceived to truly serve the community's interests.
But the core question the sources seem to grapple with, especially looking at this long, painful history, is whether these efforts or market-based solutions more broadly can truly overcome the deeply embedded structural disadvantages we've laid out.
That is the fundamental tension, isn't it? Can black banks or CDFIs or any market-focused initiative truly flourish and build wealth equitably when they're operating within an economic and financial system that wasn't just passively unequal, but was actively designed and reinforced by public policy and mainstream banking practices for centuries to extract wealth from, not build it in, these very communities?
And the historical evidence.
The historical evidence presented consistently throughout these sources suggests this has been an incredibly difficult, perhaps fundamentally impossible task for market forces alone to rectify. The headwinds created by history and structure are just immense.
So pulling it all together, what's the underlying argument the sources make about what's truly needed to address this persistent gap if market solutions face these huge historical barriers?
They argue quite powerfully that genuinely addressing the racial wealth gap isn't just about tweaking current market dynamics or encouraging more entrepreneurship, though those things might help on the margins. It requires directly confronting and acknowledging its deliberate creation through racist public policy and discriminatory banking practices over centuries.
Acknowledging the history.
Yes, and acknowledging it as what one source calls a historic breach of the social contract. The deep challenge, they point out, is that the Constitution's necessary demand for equal treatment today can, paradoxically, become a legal and political roadblock when trying to implement policies specifically designed to remedy the vastly unequal treatment and economic outcomes that were intentionally created in the past. How do you fix past inequality without using race-conscious remedies when race was the original basis of the inequality?
That brings the full weight of this history right into the present day. From the devastating failure of early attempts like the Freedmen's Bank, the broken promise of economic independence after slavery,
Right.
through the active role of government policies like redlining and FHA rules, and the actions of mainstream finance in literally building segregated financial markets,
Creating unequal access by design.
all leading to the persistent gap we see today and the resulting reliance on often exploitative fringe financial services. It's a consistent, powerful, and frankly, deeply troubling narrative that emerges from these sources.
It's a narrative showing how attempts at self-sufficiency and institution building within Black communities, while incredibly resilient and important, continuously faced immense systemic opposition and structural disadvantages.
Right.
Disadvantages that market forces, which were themselves shaped by those very discriminatory policies, simply couldn't overcome on their own.
And understanding this history isn't just an academic exercise, is it? It's not just something in a textbook. It directly shapes the financial opportunities, the challenges, the disparities that you see playing out across different communities right now.
Absolutely.
Understanding this context helps you, the listener, move beyond thinking about the wealth gap as simply a collection of individual successes or failures. It helps you see the deep, powerful systemic forces that have shaped it over generations.
It provides that crucial structural lens for understanding the present.
And that leads us to a final provocative thought for you to consider, one that builds directly on the core arguments these sources present. Given that the evidence suggests the racial wealth gap wasn't an accident, wasn't just a byproduct of market forces, but was intentionally created and actively reinforced by government policy and banking practices for centuries, can this gap ever truly be closed by relying solely on race-neutral, market-based solutions? Or does achieving genuine economic justice require a fundamental re-reckoning with that specific history and potentially implementing policies designed explicitly to remedy the ongoing effects of that past intentional discrimination?